With us is Matt Miskin, the co-chief investment strategist at Manulife, John Hancock. Matt, it's good to see you. And I mean, where would you have us start? It sounds to me like you're backing a little bit away from the Mag 7 and looking more to the value side of things. Is that right?
Yeah, Kelly, quality value is our mantra right now. Industrials are our favorite sector as we're starting to see higher return on equity, good solid companies seeing a pull through of demand. Earnings estimates into 2026 look rich to us on the tech space. They're looking for like 20 to 30% earnings growth on top of 20% last year. Industrials looking for 16% earnings growth. We think that's legit after a tougher year this year. We're seeing industrial companies likely of the biggest beneficiary from the One Big Beautiful Bill, accelerated depreciation. It's going to spur some tech capex. And what you're seeing in the aerospace and defense industry is really humming along here, ready to take flight. So
defense,
that's what we see.
Listen, we were just about to put that. Maybe they can put it back on the screen. Boeing is up 40% since November. Defense stocks have outperformed all but about the memory trade part of AI. I mean, it's almost as if if you're saying investors shouldn't trade geopolitical headlines, it's almost like you say just own geopolitical risk in the form of defense stocks and I guess in the form of the metals.
Right. And, in the metals right now, one of the other big lessons we're trying to, instill in investors is to not get the case of the FOMO. So fear of missing out right now is what we're seeing in the metals. I'm cautious there. I think that actually trimming into strength, it might be a better idea. But in terms of the industrial space, this is a part of the market that has been relatively quiet for years. It's not been the hype of the AI, but it's more so, it is the AI data center build out. That is part of it, but it's got other things. Aerospace and defense demand is still strong. We're seeing onshoring, CapEx. The Midwest is booming with manufacturing renaissance still here right in America.
You like the industrials, you like the mid caps. I've had some audience members say they're glad to see the mid caps participating. They don't love it when the Russell's outperforming. I think everyone's harping on the Russell a little too much. I like to see the small caps up there and the mid cap. Maybe they're low quality. Maybe it just is a sign that there's possibly earnings momentum elsewhere and not just in mega cap tech.
Yeah, and so amidst the small and mid-cap trades, the biggest difference you get is it's more industrials and mid, and in small, it's more regional banks. And regional banks actually coming in strong here. So they're growing earnings at double digits. You're seeing nice M&A activity, steeper yield curve. The wealth management business is doing well. But the problem is that you can get these headline risks. You can get things like regulation. You can get things like just the markets are so sensitive to it. So regional banks having a tougher day today. We think industrials, given the pipeline of demand, given the CapEx and everything else that I already referenced, might be a better spot.
So it's coming, you mentioned those results coming in hot. What about the whole idea of the run it hot trade? What does that tell you? I mean, is that also, you mentioned a lot of this is FOMO in the metals, but do you think that's what's happening here is true to the administration's word? They're just running it a little hot right now?
I think it's warm and up here in Massachusetts outside of Boston. I'll tell you, we would take some warmth and a lot less snow than we're about to get. But what we're seeing here is good growth with less inflation. This is the opposite of stagflation. I heard so much stagflation at the end of last year. In terms of the economy heading into January, it's accelerating, but not like too hot. Like the PMI and the ISM might hit just above 50. That's good. And then inflation is staying in check. Housing is actually modest growth. Housing prices are moderating. Energy prices, they're up. Oil's up today, but all things considered, not that bad. Wage growth into 2026, we think moderates. Our biggest non-consensus call is inflation moderates into 2026. That's actually a pretty bullish thing, though.